Ladies and gentlemen, we are living in a time of rapid financial evolution. Traditional investing models are being challenged, new asset classes are emerging, and the wealth building strategies of the past may not guarantee success in the future. Today, we explore This Strategy Will Make You Rich, the Future of Investing Explained, inspired by insights from Anthony Pompliano, one of the sharpest minds in finance and cryptocurrency. Traditional investment strategies have long been the foundation of wealth creation, with assets such as stocks, real estate, and bonds playing a crucial role in financial growth. For decades, investors relied on these tried and true methods to generate steady returns and build long-term wealth. However, the global financial landscape is shifting rapidly, and the same strategies that worked in the past may no longer guarantee success in the future. The rise of new asset classes, technological advancements, and changes in economic policies have made adaptability a key factor in wealth creation. Those who recognize and embrace these shifts will position themselves to thrive, while those who resist change risk falling behind. One of the most significant changes in the world of investing is the increasing influence of technology. The digital revolution has transformed nearly every aspect of our lives, including how we manage and grow our money. The rise of online trading platforms, algorithmic investing, and artificial intelligence-driven financial tools has democratized investing, making it easier than ever for individuals to participate in the financial markets, unlike in the past. When investing was largely reserved for institutional players and the wealthy elite, today, anyone with a smartphone and internet connection can access global markets, trade stocks, and invest in alternative assets. This shift has created new opportunities for wealth creation, but also presents new challenges, requiring investors to stay informed and continuously adapt to changing market conditions. Another critical factor in the changing wealth landscape is inflation and economic uncertainty. Historically, assets like bonds were considered a safe haven for preserving wealth, but with rising inflation and fluctuating interest rates, their ability to generate meaningful returns has diminished. Traditional savings accounts, once a reliable way to grow money, now offer minimal interest rates that often fail to keep pace with inflation. This means that individuals who rely solely on traditional savings methods may actually be losing purchasing power over time. To counteract these economic realities, modern investors are exploring alternative strategies such as investing in high-growth sectors, digital assets, and businesses with strong long-term potential. Real estate, long considered a cornerstone of wealth building, has also undergone significant changes. While property investment remains a viable strategy, market dynamics have shifted due to factors such as urbanization, remote work, and changes in consumer behavior. The COVID-19 pandemic accelerated trends like remote working, leading to declining demand for commercial real estate in certain areas, while boosting residential real estate in suburban and rural locations. As a result, successful real estate investors must now carefully analyze market trends, emerging hotspots, and the evolving needs of buyers and renters. Those who adapt to these changes can still build wealth through real estate, but a one-size-fits-all approach no longer applies. Another key development reshaping wealth creation is the rise of digital and decentralized finance. Cryptocurrencies, blockchain technology, and decentralized financial platforms have introduced a new way for individuals to grow and protect their wealth. Unlike traditional banking systems, which rely on intermediaries and centralized control, decentralized finance offers greater transparency, lower fees, and increased financial inclusion. While some investors remain skeptical of digital assets due to their volatility, those who understand and strategically invest in them have seen substantial returns. Bitcoin, for example, has been compared to digital gold, serving as a hedge against inflation and currency devaluation. Other blockchain-based projects provide innovative solutions in areas such as lending, payments, and asset tokenization, creating additional avenues for wealth generation. Ultimately, the ability to build wealth in today's world depends on an individual's willingness to embrace change and leverage emerging opportunities. While traditional investment strategies still hold value, they must be complemented by a forward-thinking approach that incorporates new asset classes, technological advancements, and economic trends. The wealthy are not simply those who inherit riches or save diligently. They are the ones who stay informed, take calculated risks, and continuously evolve their investment strategies. The financial landscape will keep changing, and those who adapt will be the ones who build lasting wealth. The power of compounding and long-term thinking is one of the most fundamental principles of wealth creation. It is often referred to as the eighth wonder of the world, as it has the potential to turn even modest investments into significant wealth over time. Compounding occurs when the returns on an investment are reinvested, generating additional earnings on both the initial principal and the accumulated returns. This cycle continues to grow exponentially, creating a snowball effect that increases wealth far beyond what simple interest could achieve. The key to making compounding work is time. Starting early and remaining consistent can make a dramatic difference in financial outcomes. One of the most famous examples of compounding is Warren Buffett, who built his fortune through disciplined long-term investing. While his stock-picking skills are legendary, the real secret to his wealth is time and patience. Buffett started investing as a teenager and allowed his money to compound for decades. His net worth grew exponentially in the later years of his life because the longer money remains invested, the greater the compounding effect. This illustrates why young investors, even those with limited capital, should start investing as soon as possible rather than waiting for the perfect time to enter the market. The longer money is given to grow, the more powerful the results. Compounding is not limited to stocks alone. It applies to various asset classes, including real estate, bonds, and dividend investments. In the stock market, investors who reinvest their dividends instead of withdrawing them benefit significantly from compounding. Over time, these reinvested dividends buy additional shares, which in turn generate more dividends, creating a cycle of continuous growth. Similarly, in real estate, rental income that is reinvested into additional properties or property improvements can yield higher returns in the long run. The principle remains the same. The more consistently money is reinvested, the greater the financial rewards over time. A common mistake investors make is focusing on short-term gains instead of long-term wealth building. Many people chase quick profits, frequently buying and selling assets in an attempt to time the market. While some short-term traders succeed, the vast majority do not outperform long-term investors who simply buy and hold quality assets. The stock market has historically experienced volatility with periods of downturns and corrections, but over extended periods, it has consistently trended upward. Those who panic during market declines and sell their investments often miss out on the recovery and compounding benefits that come with time in the market. Another important aspect of compounding is consistency. Investing regularly, even in small amounts, can lead to significant wealth accumulation over time. This is why many financial advisors recommend strategies such as dollar cost averaging, where investors contribute a fixed amount of money at regular intervals regardless of market conditions. This approach removes the emotional aspect of investing and ensures that investors continue to accumulate assets over time. Those who commit to long-term investment plans, such as retirement accounts or index funds, benefit from the discipline of systematic investing and the power of compounding. Inflation is another reason why long-term investing and compounding are essential. Over time, the cost of goods and services rises, reducing the purchasing power of money. Simply saving money in a bank account with low interest rates is not enough to preserve or grow wealth. Investments in assets that outpace inflation, such as stocks, real estate, and certain commodities, are necessary to maintain financial security. Long-term investors who allow their wealth to compound in high-growth investments are more likely to experience financial stability, even in inflationary environments. The mindset of long-term thinking goes beyond investing. It applies to personal growth, career development, and financial planning. Just as wealth compounds over time, so do skills, knowledge, and relationships. Those who consistently invest in their education, business ventures, and professional growth see exponential rewards later in life. The most successful individuals understand that true wealth is built through patience, discipline, and the ability to let time work in their favor. The rise of decentralized finance, DeFi, and Bitcoin is transforming the global financial system, offering new ways for individuals to grow and manage their wealth. Traditional financial institutions, such as banks and investment firms, have long controlled access to financial services, acting as intermediaries between individuals and their money. However, blockchain technology and decentralized networks are changing this dynamic, creating a more open, transparent, and efficient financial ecosystem. Bitcoin, the first and most well-known cryptocurrency, has emerged as a digital store of value, while DeFi platforms provide decentralized alternatives to banking, lending, and investing. As these innovations continue to develop, they present new opportunities for investors to participate in a financial revolution that is reshaping wealth creation. Bitcoin is often referred to as digital gold because it shares similar characteristics with physical gold but offers additional benefits. Like gold, Bitcoin has a limited supply with only 21 million coins that will ever exist. This scarcity makes it an attractive hedge against inflation and currency devaluation, especially in times of economic uncertainty. Unlike traditional fiat currencies, which can be printed in unlimited amounts by governments and central banks, Bitcoin supply is fixed and controlled by a decentralized network of miners and nodes. As a result, many investors view Bitcoin as a safe haven asset that protects wealth from the eroding effects of inflation. Over the past decade, Bitcoin has outperformed most traditional assets, delivering substantial returns for those who held it as a long-term investment. Beyond being a store of value, Bitcoin and other cryptocurrencies offer a new way to conduct financial transactions without the need for intermediaries. In the traditional banking system, sending money across borders can be expensive and time-consuming due to fees, exchange rates, and regulatory restrictions. Bitcoin, however, enables near instantaneous and low-cost transfers, regardless of geographical location. This has significant implications for financial inclusion, particularly in developing countries where access to banking services is limited. By providing a decentralized alternative to traditional finance, Bitcoin empowers individuals to take control of their own money without relying on third parties. Decentralized finance, DeFi, expands on the principles of Bitcoin by offering a wide range of financial services without the need for banks or traditional financial institutions. DeFi platforms operate on blockchain networks using smart contracts to automate lending, borrowing, trading, and yield generation. Unlike traditional banks, which require credit checks, collateral, and lengthy approval processes, DeFi protocols enable anyone with an internet connection to access financial services. This has opened up new opportunities for individuals who were previously excluded from the global financial system, allowing them to participate in wealth creation without traditional barriers. One of the key advantages of DeFi is its ability to offer higher returns compared to traditional savings accounts and investment products. Many DeFi platforms provide opportunities for users to earn interest by lending their assets, staking tokens, or participating in liquidity pools. These returns are often significantly higher than the interest rates offered by traditional banks, making DeFi an attractive option for investors looking to maximize their passive income. However, as with any investment, DeFi also carries risks, including smart contract vulnerabilities, market volatility, and regulatory uncertainty. Investors must conduct thorough research and manage their risk exposure to navigate this evolving space successfully. Despite the rapid growth of Bitcoin and the mainstream financial industry and regulatory bodies have been slow to fully embrace these innovations. Some governments have attempted to regulate or restrict cryptocurrency usage, fearing its potential impact on monetary policy and financial stability. However, as adoption continues to increase, Many institutions and businesses are beginning to recognize the benefits of blockchain technology. Major companies and investment firms have started incorporating Bitcoin into their balance sheets, and financial institutions are exploring ways to integrate DeFi solutions into their existing services. This growing acceptance suggests that decentralized finance and Bitcoin are not just passing trends, but fundamental shifts in the way wealth is created and managed. As the financial landscape continues to evolve, individuals who educate themselves about Bitcoin and will be better positioned to capitalize on emerging opportunities. The traditional banking system is being disrupted, and those who understand and adapt to these changes can take advantage of new ways to build and preserve wealth. Whether it's investing in Bitcoin as a hedge against inflation or participating in DeFi protocols to generate passive income, the rise of decentralized finance offers unprecedented possibilities for financial freedom and independence. The future of investing is decentralized, and those who embrace it early stand to benefit the most. Ignoring financial innovation is a mistake that many investors make, often due to fear of change or lack of understanding. Just as the internet revolutionized industries like retail, media, and communication, emerging financial technologies are reshaping the way people invest, transact, and build wealth. Those who fail to recognize and adapt to these changes risk missing out on significant opportunities, while those who embrace innovation can position themselves ahead of the curve. The financial world is evolving rapidly, and investors who ignore advancements such as artificial intelligence, AI, blockchain, and decentralized finance, DeFi, may find themselves at a disadvantage. One of the most significant financial innovations in recent years is the rise of artificial intelligence in investing. AI-driven algorithms can analyze massive amounts of data at speeds far beyond human capability, identifying trends and making investment decisions with remarkable accuracy. Automated trading platforms and robo-advisors are already being used by investors to optimize their portfolios and execute trades based on real-time market conditions. These AI systems reduce human error, remove emotional biases, and improve efficiency in portfolio management. Investors who rely solely on traditional methods without leveraging AI-driven tools may struggle to keep up with the speed and precision of algorithmic trading. Blockchain technology is another groundbreaking financial innovation that is transforming the way assets are owned, transferred, and secured. Beyond its role in powering cryptocurrencies like Bitcoin and Ethereum, blockchain has applications in areas such as supply chain management, digital identity verification, and tokenized assets. One of the most promising innovations within blockchain is tokenization, which allows real-world assets like real estate, stocks, and commodities to be represented as digital tokens on a blockchain. This technology increases liquidity, reduces transaction costs, and enables fractional ownership, making it easier for individuals to invest in high-value assets that were previously out of reach. Investors who ignore the potential of blockchain risk being left behind in a world where asset ownership and transactions are becoming increasingly digitized. Decentralized finance, DeFi, is another innovation that is challenging the traditional banking system and creating new opportunities for investors. Unlike traditional financial institutions that require intermediaries such as banks and brokers, DeFi platforms operate on blockchain networks, enabling peer-to-peer transactions without middlemen. This decentralized approach reduces fees, increases transparency, and provides greater access to financial services. Investors can earn high yields by participating in decentralized lending, staking, and liquidity pools. While DeFi carries risks, such as smart contract vulnerabilities and regulatory uncertainty, its potential to disrupt traditional finance is undeniable. Those who dismiss DeFi as a passing trend may miss out on one of the most significant financial revolutions of the 21st century. Another key area of financial innovation is the development of central bank digital currencies, CBDCs. Governments and central banks around the world are exploring the possibility of issuing digital versions of their national currencies. Unlike cryptocurrencies, CBDCs would be backed by governments and integrated into the existing financial system. The adoption of digital currencies could streamline transactions, reduce fraud, and improve financial inclusion. However, they also raise concerns about privacy, government control, and potential displacement of traditional banking services. Investors who stay informed about the evolution of digital currencies will be better prepared to navigate the changing financial landscape. History has shown that those who resist technological advancements often fall behind. When the internet first emerged, many businesses dismissed it as a temporary trend. Companies that failed to adapt, such as traditional brick-and-mortar retailers, lost market share to e-commerce giants like Amazon. Similarly, the rise of streaming services disrupted the entertainment industry, leaving traditional media companies scrambling to catch up. The same pattern is occurring in the financial world today. Those who ignore innovations such as AI-driven investing, blockchain technology, and DeFi may find themselves struggling to compete in an increasingly digital economy. Investors who embrace financial innovation and stay ahead of emerging trends will have a significant advantage over those who cling to outdated methods. While traditional investment principles remain valuable, they must be combined with an openness to new technologies and strategies. The financial landscape is evolving, and the ability to adapt is crucial for long-term success. Those who recognize the potential of financial innovation and take action today will be the ones who build wealth in the future. Investing in oneself and one's network is one of the most powerful strategies for long-term financial success. While financial markets and asset classes often take the spotlight in wealth-building discussions, it is important to remember that human capital, the skills, knowledge, and relationships that individuals develop over time, can often be the greatest driver of wealth. The ability to continuously grow and adapt, as well as the connections built along the way, can create opportunities that monetary investments alone cannot. Building a strong foundation of skills and a network of valuable relationships offers a competitive edge in today's rapidly changing world. One of the most fundamental ways to invest in oneself is through education. Whether formal or informal, education equips individuals with the knowledge and skills needed to excel in their careers, start businesses, or make informed investment decisions. In the past, traditional degrees from universities and colleges were the primary avenues to gain expertise. However, in today's world, there are countless alternative methods for acquiring knowledge, such as online courses, certifications, seminars, and mentorships. The accessibility of information has never been higher, and individuals who take the time to learn continuously are better positioned to seize new opportunities. As industries evolve and new fields emerge, the ability to stay current and acquire relevant skills becomes crucial to maintaining a competitive advantage. Investing in education is a long-term strategy that not only enhances personal growth, but can lead to better career prospects and higher earning potential. Additionally, honing personal skills, particularly those that improve productivity, communication, leadership, and problem solving, can significantly boost one's effectiveness in both personal and professional settings. Mastering soft skills such as emotional intelligence and adaptability can often be just as important as technical expertise in the workplace. The ability to manage relationships, work as part of a team, and navigate challenging situations is essential in creating lasting success. Individuals who focus on personal development and become highly effective in their roles are likely to see greater career advancement and financial rewards. Another critical aspect of investing in oneself is entrepreneurship. Starting a business or side project can be an excellent way to create new income streams and build long-term wealth. Entrepreneurship involves taking calculated risks, learning from failures, and developing an innovative mindset. By creating value for others, whether through a product, service, or idea, entrepreneurs have the opportunity to generate wealth while making a positive impact on their communities. Even if someone is not ready to fully launch their own business, investing in entrepreneurial skills such as understanding market trends, finance, and customer needs can help them excel in their career or side hustle. This kind of mindset helps individuals recognize opportunities where others might see obstacles, turning potential ideas into profitable ventures. Networking, often regarded as a tool for advancing career prospects, is equally important in building wealth. Having a solid professional network opens doors to new opportunities, partnerships, and investments. Relationships with mentors, colleagues, business partners, and industry experts can provide invaluable guidance and support. By expanding one's network, individuals can tap into resources, knowledge, and opportunities that they might otherwise miss. Networking is not just about who you know, but also about what you learn from others and how you collaborate. Building meaningful, genuine relationships with others in your field creates a foundation for future success, whether it's securing new clients, finding investors, or receiving career advice. The power of a network extends beyond the professional realm as well. Having a diverse group of people, friends, family, and acquaintances who support your personal and professional growth can lead to many opportunities. Strong relationships often offer emotional support, boost confidence, and provide helpful feedback. They can also open doors to new opportunities that may not be immediately apparent. Those who invest in their social networks tend to have a more balanced and fulfilling life, with access to a wide range of perspectives and experiences. Moreover, the value of investing in oneself and one's network grows exponentially over time. As individuals continue to develop new skills and expand their connections, the returns on their personal investments compound. Over the years, a well-built network and a wealth of experiences create opportunities that weren't visible at the outset. Just as with financial investments, the earlier you start investing in yourself and your relationships, the greater the potential for long-term growth. Ultimately, investing in oneself and one's network provides the foundation for success in any field. While external factors like the stock market, real estate, and digital assets are important components of wealth creation, personal development and strong relationships play an equally vital role. By continuously learning, developing new skills, and building meaningful connections, individuals set themselves up for lasting success. The most successful people understand that their greatest asset is not necessarily their financial portfolio, but rather their ability to evolve, adapt, and connect with others in a way that unlocks new opportunities. The importance of maintaining discipline and a long-term perspective in investing cannot be overstated. In a world filled with market volatility, rapid changes, and the constant temptation of short-term gains, it is easy for investors to become distracted or fall into impulsive decision-making. However, successful investing is rooted in patience, strategic planning, and the ability to stay the course, even during turbulent times. Maintaining a disciplined approach allows investors to weather market fluctuations and remain focused on their long-term goals, ultimately leading to more consistent and reliable wealth creation. One of the primary reasons discipline is crucial in investing is the impact of market cycles. Financial markets are cyclical, meaning they experience periods of growth followed by periods of decline. It is natural for markets to experience volatility, whether due to economic downturns, political events, or other factors. Investors who lack discipline may panic during market drops, selling off their investments at a loss or attempting to time the market by predicting the next uptrend or downturn. This reactive approach can result in missed opportunities for long-term growth and often leads to poor financial outcomes. In contrast, disciplined investors who take a long-term view understand that market fluctuations are part of the investing process and avoid making emotional decisions based on short-term events. They remain committed to their strategy, allowing their investments to grow over time. A long-term perspective allows investors to take advantage of the compounding effect, which is most powerful over extended periods. The longer an investor stays invested, the greater the potential for their assets to appreciate regardless of short-term market movements. This is why investors who consistently invest in high-quality assets, such as stocks, real estate, or index funds, often see substantial returns over the long run. Instead of chasing quick profits or reacting to market noise, disciplined investors focus on building wealth steadily and gradually. In addition to fostering patience and resilience, discipline helps investors stick to a well-thought-out plan and avoid costly mistakes. By setting clear financial goals, determining appropriate risk levels, and adhering to a strategic investment plan, investors can stay focused and avoid the temptation to make impulsive decisions. With a disciplined approach, investors are more likely to stay committed to their long-term objectives, even when short-term challenges arise.